Today is Wednesday, April 15th, 2026. Silver closed yesterday at $79.19, up 4.85% in a single session. That was the biggest single-day green candle since the ceasefire announcement on April 8th. And right now, this morning, silver is hovering right around that $79 to $80 range, testing one of the most critical price levels of this entire year. But I need you to pull your attention away from that price chart for the next few minutes, because while every silver commentator this morning is talking about Iran peace talks and yesterday's rally, a deadline is expiring tonight in Washington that directly threatens 25% of every ounce of silver mined on this entire planet. Tonight, April 15th, 11:59 p.m. Eastern Time. And the world's largest primary silver mining company already told you exactly what happens when this process begins, before a single tariff dollar was ever collected. Fresnillo cut its 2026 production guidance by 9 to 11%. Not after tariffs landed, not after July. Right now, under uncertainty alone, and First Majestic followed with an 11% cut of their own. The tariffs have not even started yet. So what happens to silver supply when they do? Let's go through the hard numbers, because this is the supply story that mainstream financial media is completely ignoring today, and it is far more consequential for silver's price trajectory than any Iran ceasefire headline. Fresnillo is not a company most American or British investors think about regularly. That is a serious blind spot. Fresnillo PLC trades on the London Stock Exchange and operates 6 major mines across Mexico: Fresnillo, Saucito, Ciénega, Herradura, Nochebuena, and San Julian. These are not small regional operations. These are world-class industrial-scale silver producing assets that have been running for decades and feeding global supply chains continuously. In 2025, Fresnillo produced approximately 55 to 58 million ounces of silver. Global annual mine supply runs 810 million ounces per year. Fresnillo alone is responsible for roughly 7% of all silver mined on Earth from a single company. Now add First Majestic Silver, also heavily Mexico-focused, and then add Endeavor Silver, Mag Silver, Gato Silver, and dozens of smaller Mexican producers. When you combine total Mexican silver output, you arrive at approximately 200 million ounces annually. That is 1/4 of global mine supply coming from one country. And tonight's 11:59 p.m. deadline closes the public comment window on tariff investigations that could permanently restructure the economics of mining in that country. Here is the specific legal mechanism, and most financial content gets this completely wrong. Section 301 of the Trade Act of 1974 gives the U.S. Trade Representative broad authority to investigate and impose tariffs on countries engaged in what the law calls unreasonable or discriminatory trade practices. The USTR launched 2 separate Section 301 investigations in March 2026. The first targets 16 economies for industrial overcapacity. The second targets 60 economies for forced labor enforcement failures. Mexico appears on both lists simultaneously. After tonight's comment window closes, the formal legal process advances. Public hearings on forced labor begin April 28th. Overcapacity hearings start May 5th. And the USTR has explicitly stated this investigation operates on an accelerated timeline, with tariff implementation no later than July 24, 2026. That is a hard statutory deadline written into the investigation framework. Not an estimate, not a projection. 99 days from today. Now here is where the math becomes genuinely alarming for anyone tracking physical silver supply. Global silver mine supply is 810 million ounces per year. Global silver demand is 877 million ounces per year. The current annual deficit is 67 million ounces, and this is the 6th consecutive year of deficit. The cumulative deficit from 2021 through 2025 is 820 million ounces, permanently consumed in solar panels, electronics, electric vehicles, and industrial applications. That silver is gone. It cannot be recycled fast enough to replace what industry is consuming. Now apply Mexican tariff risk on top of that baseline deficit. A 15 to 25% tariff, which is what Section 301 can produce, does not simply add a tax that miners absorb and move on. It restructures the entire economic viability of Mexican silver operations. Silver mining runs on thin margins, when energy costs are already surging. And yesterday's official March PPI data from the Bureau of Labor Statistics confirmed diesel fuel at the intermediate producer level is up 42% year over year. Mexican mines are already absorbing an enormous cost shock just from fuel alone. Those mines run on diesel, layer a 15 to 25% tariff on top of a 42% diesel cost increase, and multiple Mexican silver operations cross from profitable to economically unviable in a single policy announcement. Mines that become unviable do not gradually wind down production over months. They suspend operations on a specific date. The silver stops coming out of the ground. Supply does not gradually decline, it falls off a cliff. Fresnillo already showed us what the math looks like under uncertainty alone. Their 9 to 11% guidance cut represents approximately 5 to 6 million ounces of silver that will not be produced in 2026 from that single company. First, Majestic's 11% cut adds several million more. Combined, these two companies alone are removing 7 to 9 million ounces from 2026 supply projections, and tariffs have not even been formally confirmed yet. When tariffs land in July, industry analysts project an additional 10 to 20% production reduction across Mexican operations on top of the guidance cuts already made. Apply that to the full 200 million ounces of Mexican supply, and you are looking at an additional 20 to 40 million ounces removed from global supply in a single year. Add that to the existing 67 million ounce deficit, and you're now facing a combined supply gap of 87 to 107 million ounces in 2026 alone. And there is no emergency silver reserve sitting in a warehouse. New mines require 5 to 7 years minimum to develop. There will be zero new significant silver mine production before 2031. Whatever supply exists today is what the global economy has to work with. Now here is the disconnect that should genuinely frustrate any informed investor. Silver is trading at $79.19. Yesterday, it surged 4.85% because Trump told the New York Post that new Iran negotiations could happen in the next 2 days. A newspaper quote that moved silver nearly 5%. The Section 301 deadline tonight moved the price exactly zero. Fresnillo's guidance cut moved the price zero. The sixth consecutive annual deficit moved the price zero. The fact that COMEX registered silver inventory, the only silver actually available for physical delivery on the exchange, sits at just 76 million ounces, covering only 14% of outstanding paper claims, moved the price zero. The paper market is responding to geopolitical headlines. The physical supply fundamentals are not yet reflected in the price at all, not 1 cent. Bank of America's silver price target range is $135 to $309. Deutsche Bank targets $100. Citi targets $150 to $170. These are not predictions from independent newsletter writers. These are price targets from institutions with trillion-dollar balance sheets and research departments employing hundreds of analysts. And critically, none of those targets incorporate full Mexican tariff impact. They were calculated assuming Mexican production continues at roughly current levels. If July tariffs land and Mexican output drops another 10 to 20% on top of the pre-tariff guidance cuts already announced, those institutional targets move higher from where they already sit. The gold-silver ratio right now is 60 to 1. Gold is trading at approximately $4,121. At a ratio of 50 to 1, which is still above the long-term historical average, silver prices at $96.42. At the ratio that existed at silver's January 2026 all-time high of 44 to 1, silver prices at $109.57. Neither calculation requires anything unusual or extreme. They just require the ratio to return to where it has historically traded for decades. Silver is simultaneously the best performing major asset of the past 12 months at 144% year over year. It was trading around $32.50 a year ago, and still 34.3% below its own January 29th all-time high of 121.62. It is 60% below its inflation-adjusted 1980 high of $194 in today's dollars. These facts coexist because silver's January spike was followed by what was technically the worst single-day crash since 1980, a 31.4% collapse driven by margin hikes, not by any change in the physical supply-demand reality. The physical reality never changed. 3 CME margin hikes in 2026 changed the paper price. And speaking of physical reality, Samsung Corporation has already stopped waiting for COMEX to figure itself out. Samsung locked up 100% of La Parrilla Mine's silver output for the next 2 years through a direct purchase agreement, bypassing the exchange entirely. When one of the world's largest electronics manufacturers decides the exchange cannot reliably deliver the metal they need for production and goes directly to a mine to secure supply, that is not a minor signal. That is a company saying the paper market and the physical market have fundamentally separated, and they need guaranteed access to the physical. COMEX registered silver inventory is draining at a rate that implies exhaustion in approximately 131 trading days, roughly around August 2026. In January 2026 alone, COMEX processed 49.4 million ounces of physical silver deliveries. In January 2025, the same figure was approximately 7,000 ounces. That is a 57% increase in physical delivery demand in 12 months, and it received almost no mainstream financial coverage. The Federal Reserve Beige Book also releases today, the first comprehensive economic assessment from all 12 Federal Reserve districts since the Iranian oil shock began. Watch for stagflation language. Watch for consumer spending deterioration alongside persistent inflation readings. If the Beige Book confirms the economy is weakening while prices remain elevated, the case for Fed rate cuts in late 2026 strengthens. And lower rates are historically one of the most powerful tailwinds silver has. The Fed's April 29th meeting carries zero probability of a cut right now, according to CME FedWatch. But December 2026 cut probability has already climbed to 30% and improving. Every basis point the market prices toward a future cut adds support to silver's monetary case on top of everything happening in physical supply. The complete picture for today is this. Silver at $79.19 is testing the $80 psychological level and the 50-day moving average at $80.90 simultaneously. A daily close above $80.90 confirms the technical cup and handle pattern that analysts have been watching, with a measured price target of 102.29 on the breakout. RSI sits at a neutral to bullish 52 to 58, not overbought, which means the rally has room to continue without technical exhaustion. The ceasefire between the US and Iran expires in approximately 6 to 7 days around April 21st to 22nd. A second round of talks is reportedly being arranged. Trump confirmed to the New York Post on Tuesday that negotiations could happen within the next 2 days. If a deal or extension emerges, silver breaks through $82 resistance decisively. If the ceasefire expires without resolution, oil spikes back toward $99 to $105, and silver faces near-term pressure from renewed inflation and Fed hawkishness. But here's what does not change, regardless of what happens with Iran. The Section 301 deadline closes tonight. The formal process toward July tariffs on Mexican silver advances. Fresnillo already cut guidance by 9 to 11% under uncertainty alone. The global deficit is in its 6th consecutive year. COMEX is draining towards zero in 131 trading days. Samsung went directly to the mine because the exchange could not guarantee supply. And the price on your screen has priced in exactly none of it. The overnight silver price model that isolates trading completely outside COMEX hours, when the paper suppression mechanism is absent, currently implies $382 per ounce. Your screen shows $79 at 19. The difference between those two numbers is the information advantage that exists right now before the physical supply reality fully arrives in the paper price. Today is Wednesday, April 15th, 2026. The Hidden AG. Man, see you tomorrow.